little bit, I know this is little bit challenging. Very simple. It's not so easy as we have done first two questions. Is it right? Very simple. It's not as easy as we have done first. What they are asking, what is the contract asset to be recognized in 2009? 2009, how much we have completed? 75%. Now they have mentioned it. First, what we have to do, what we have done total, how much we have done with respect to cost to date. Is it right? This is what we are doing. We have taken into consideration was cost to date. Next, when you have taken into, we have to take estimated cost of completion. Is it right? Estimated cost of completion is how much? Definitely, estimated cost of completion is 700. Is it right? If 700 is estimated cost of completion, how much we have incurred the cost? Is that how much we have incurred the cost as such? Is that on this 700? Is it right? On this 700, there is some element of profit. Is it right? There is element of profit, cost to completion. We will take that proportion only. Is it right? We have taken the cost to date. Is that we have taken the cost to date, and from this we will take how much? We will take 75%. Once you have taken the 75%, we will add it. Is that very simple? You can make it in a very simple case also. Is that 3.6? Is that 3.6 into 75%? It comes to how much? 525. Is that you have worked invoiced? Is it right? Worked invoiced is how much? Is that 1 minute? Is it right? This is addition. Worked invoice is how much? Worked invoice is 3 million. That's all. How much you'll get? How much you'll get? 1125. This is a shortcut. Subject to understanding. Okay? Subject to understanding. This is the shortcut. How for? See, how for? This is plus, this is plus, this is minus. Three 6 plus 525 minus 360 plus 525 minus 3. Check again. It is not 4125. It is 1125. Huh? That's how here this is that is the total asset value, and this is the contract asset value. How much? 1125. Total asset value is 4125. How much is the work invoice to date? Work invoice to date is 3 million. Is it? Total asset value minus work invoice date is nothing but the contract asset value. Revise it. Okay, please. revise it if it's very important. Is there any doubt? Is there? You ask me anytime, either on WhatsApp. You can ask me in the next class. We are here to work it out. Is it right? Slowly, the moment we will do the repeated questions, we will get more comfortable in understanding. Can I go to the next one? Bridge North Company measures performance obligation completed by reference to percentage of completion, which identify which two of the following would be acceptable methods by measuring performance obligation completed. I will just go through the revenue. Okay, I will just go through the revenue. Is it right? I think there is performance obligation. See that there are two performance obligation within the contract. Supply of contract, fine. Is it right? 1 minute. I think we have done performance obligation here. Step 2. Step 2 is performance obligation. Is it right? Step 2 is performance obligation. Recognize revenue when performance obligation is satisfied. When performance obligation is satisfied, entity has the right to payment, customer has right to legal right of the asset. No, this is not the case. Revenue recognition, contract revenue, performance obligation. Determination of progress of the contract, profit and loss, financial position, Baker. Fine, no problem. Maybe one minute. I will explain you that. Fine, I will explain you that. Fine. Now, what is the what we have done? See what we have done in the previous case. Okay, it is basically related to the previous step as such. When there is a what they are asking, which of the following would be acceptable method of measuring performance obligations completed? Is it right? Now, whenever is it what we have done? Performance obligation completed. See, work invoiced to date as a percentage of total contract price. See, understand the English, as simple as that. Work invoiced to date as a percentage of contract price is nothing but performance obligation. How much you have performed, that much is the total invoice, work invoice to date. Is it right? Means how much we have, see how much we have completed, that much they will pay. Fine. Cash received to date as a percentage of total how much we have completed, that much cash we will receive. Is it right? This is also a performance obligation. Cost incurred, it is not cost incurred, how much we have received, how much they have certified. Is it right? Here what we are doing, how much we have certified is a performance obligation. How much is the cash received is a performance obligation. Whereas cost incurred as a percentage is not a performance obligation. Time spent, we are never going to assess the contract on the basis of time. Is it right? We never take into consideration that you may spend more time, but you have not completed the job. That is not going to be considered. Neither the cost will consider nor the time will consider. The answer is what? The answer is how much you have certified the work and how much you have received the cash. If at 31st December 2008, Bridgenorth Company has completed only 10% of the contract for cost of how much? 400,000, and felt that it is too early to predict whether or not the contract will be profitable. What amount, if any, could Bridgenorth have recognized as a revenue? Can you just understand this? See, if at 31st December they have completed only 10% of the contract for cost. Is it only they have completed how much? 10% of the contract to cost. People will contract to cost. Is it right? And felt that it is too early to predict whether or not the contract will be profitable. Is it right? In that case, cost incurred to date. Is it cost incurred to date? How much is the cost incurred to date if at 31st December 2008, Bridgenorth has completed only 10% of the contract price? 1 minute. They have mentioned anything here? No, it is not related to the scenario as such. Is it right? It is not related to scenario. No way it is related to scenario. It is for that is different. This is different. Is it right? Cost incurred to date is how much? See, if 31st December has completed only 10% of the contract for cost of how much? They have incurred, see, this is the amount they have incurred on the contract. Is it right? Contract for cost is, they have completed 10% of the contract for, they have completed 10% of contract for cost of how much? For cost of 400,000. This is nothing but cost to date. See, listen carefully. See, they are playing with the words. They have completed only 10% of the contract for cost of how much? For the cost of 400,000. If they have completed 400,000, what amount, if any? Is it what amount? The rule of IFRS, IFRS 15 revenue for the contract says that whatever the cost contract for cost to date, is it right? Cost incurred to date should be treated as revenue. This is the somewhere we have covered this. Is it? So here they have not mentioned anything with respect to the contract. What is the contract price? They have mentioned very that is the reason, is right? They have mentioned 10% of the contract for cost how much? To complete 10% of the contract, how much they have incurred? They have incurred 400,000. If they have incurred 400,000, how much is the revenue they are going to make sure? They are going to make sure revenue upon the As per IFRS, the same amount has been treated as what? The same amount has been treated as revenue. Is it right? I want to make sure. Is it right? I will want to make sure that where we have which slide we have done. Okay, that makes us more specific on statement of current. They will know percentage of revenue recognized, cost of sales recognized in the cost of sales, recognized in the previous. No, I think somewhere here, is it? Based on the, see, there is based on the inputs used, a commonly used measure looks at contract cost incurred to date as a percentage of total expected cost. See the thing. This is it. See, is it right? Which slide it is there? Slide number is not there. Is it right? Step 2. Determine the progress of the contract. Is it right? Determine the progress of the contract. The rule says that if revenue is earned equally over time, providing if earning over time, then revenue should be recognized on the basis. What they say? See the thing. If whatever the expenses you are going to have, is it right? Here it has been mentioned. Whatever the expenses you are going to have, those expenses should be treated as the revenue. Is it? Step 2, determine the progress of the contract. Is it right? I will put very clearly here. Is it right? I will put very clearly here. 1 minute. Step 2, I will write a determining the revenue of the contract. The revenue of the contract, it says that whatever the contract cost or expenses should as per the output method. As per the output method, whatever the cost expenses is there, it has to be treated as what? It has to be treated as a revenue. Is it? Based on this method rule, is that we are making that point as such. Is that? Step, we refer this again wherever it is going to possible. I will again repeat. I will again go in detail. Another example will there. The concept will be more clear. Is right? These are the things. How is it right? How they will give the scenario in section B. In section B scenario, they will give you a calculations as well as they will give you some theoretical questions. Is it okay? You should ask me doubts. Very, very simple. The more you ask me doubts, the more it will be easy for me. Is that then only I can say that every time yes means I will have a doubt. Is it okay, Shifa?
Yes, it's okay.
No, I can understand from your voice. I can understand from your voice. Is it right? If you people will understand, your response will be in a your voice will be very specific. Okay, fine, no problem. The more we will do, will get. It is still the beginning. Okay, now this is the borrowing cost. Is it right? This is the borrowing cost. 1 minute. 1 minute. We'll do something which we'll do this. Just I'm not talking about the thing. Is it right? Fine. Is that right? Now, can you guess from which chapter it is there? Just guess from which chapter it is there. Convertible bonds, nominal coupon rate, redeemable, equity shares. We are talking in terms of what? We are talking in terms of which one? Financial assets and financial liabilities. Is it right? Financial assets and financial liabilities. Chapter 9. Is it right? This is what? This is where is that? This is chapter 9. Burnett, is it right? Put the date. Uh, 3/11 2022. Bertrand Company issued 10 million convertible loan notes on 1st October that carry a normal coupon of how much? Normal means on 1/10/2010 they have issued 10 million. Is it right? They said convertible loan. Convertible loan means it can be converted into equity. Is that convertible to equity with a nominal value at the rate of how much? At the rate of 5%. That they are redeemable on 30th of September 2003 after 3 years and par exchange for equity shares on the basis of 20 shares. Is it means for 20 shares? Is it right? They are going to issue one how much for 100% of loan. Is it right? If you have a 100% of loan, it will be converted into 20 shares. A similar note with without the conversion. This is what we are talking about, conversion. This is the conversion rule. Is it right? This is the conversion rule. What is the without the conversion? What would be required? Bertrand come to pay rate of interest of how much? Rate of interest means without conversion. Is it right? Without conversion, the rate of interest will be how much? 8%. The present value has been given. Is it right? At the end of the each year. Fine. The present value is given at the end of the each year. Fine. How should the convertible loan notes be accounted for? As a debt or debt and equity or equity and as debt until conversion, then as equity. How the convertible loan? See, they have issued it on 1/10/2010. They are going to be expired on what? It is going to be expired on 30/9/2003. Fine. Now, how we have what? This is a theory question. Okay, this is a theory question. How the convertible loan notes be accounted for? Convertible loans will be accounted for. Convertible, see, it is a loan. Till it is not converted, it will be loan only. 100%. Till it is not converted, it will be loan only. It will be non-current liability only. Once it is converted, no. As debt until conversion, then as equity, no. You cannot have two answers, okay? You cannot have. See what they are saying? They are saying that they are redeemable at par. That will happen. Is it? Converted, that will happen. But till it is there, you have to treat is it right? Till it is there, you have to treat it as debt. And once it is converted, then it is going to be treated as equity. Is that the moment we are saying it is a convertible loan means convertible loan will be there. See, till this period it will be what? It will be debt. After, is it right? After 39/2003, it will be going to be identified as equity. Answer is it is not as 1 minute. It is not. Sorry, allow me. It will be debt, and then it will be as a equity. Understand, bro? This is the basic thing. Till it is as debt, until conversion, then as equity. No. Is it? If it will be debt during this period, it will be debt, and then it will be, and after that it will, because conversion is element having debt and equity. Understand? But convertible means it has a compound element. It has the element of debt as well as equity. What amount of the amount that will be recognized as a finance cost for the year ended 2001? Is it what will be the finance cost? How much is the interest you have to pay? You are paying, say, how much is interest you are going to pay? What is the amount that will be recognized as a finance cost for the year ended 2001? We have to take into consideration, I am writing the steps, okay? We have to take into consideration interest payable. Is it right? We have to take into consideration interest payable. Is it right? With respect to what? With respect to present values. Fine, with respect to, we have to take into consideration the capital payable also. Is that again when we are going to pay capital at the end of year 3? Is it right? At the end of year 3, again you have to take what? You have to take the present value. Is it right? Then what happens if you take both the things? You will get what? You will get the total debt. Is it right? What is the finance cost? Finance cost is nothing but total debt, is it right? Total debt at present value times rate of interest. Okay, this is the formula which you have to follow. Is it? First you have to take interest payable at present values. Fine. Now I will follow the same structure. Is it right? What is the interest payable? Interest payable. Is it right? Interest payable. How much you are paying interest? Is that interest payable for how many years? For 3 years. Is that for how many years? 3 years. How much is the principal amount? Principal amount is 10 million. Is that principal amount is how much? 10 million. Is that principal amount is how much? 10 million. 1 minute. Fine. See, they have mentioned, see the things. They have mentioned, see, they have mentioned a nominal rate of interest. It is how much? Coupon is how much? 5%. Fine. And they have said that what is the required rate of return? That would be required to pay a interest of how much? To pay interest of 8%. Is that right? To pay interest of how much? To pay interest of 8%. Fine. Now, means how much you are paying? You are paying the rate of interest at the rate of 8%. Fine. Now, how much is the amount, rate of interest we will pay? Is that no? Well, first you see, I have to be very, very specific. 1 minute. Is it right? Very, very specific. 1 minute. Otherwise, you will find it little bit difficult. Okay. Fine. Interest payable. Is it right? Interest payable at nominal rate discounted at the required rate. You will pay interest at the not coupon value. Whatever the amount is there on the bond, 5% rate of interest you will pay. But present value will be different. Okay, present value will be different. Now, how much is there? You take into consideration the bond total bond value. Total bond value is how much? 10 million. Fine. Now, add. Is it right? Nominal value of interest. Is it right? Nominal value of interest at the rate of 5%. Is it right? At the rate of 5%. How much we will get? 10 million 0.05. It comes to how much? It comes to 0.5 million. Is it right? Understand? It comes to how much? 0.5 million. How much is there? 10.5 million. Fine. This to be discounted. Is it right? This will be discounted at the rate of 8%. This is called as required rate of return. For how many years? For 3 years. How much is there for 3 years? Required rate of the one, it is how much? It is 2.58. Fine. It is how much? It is 2.58. 1 minute. No. No, 1 minute. Little bit more simplify I have to do. Okay. 1 second. 1 second. Just wait 1 second. 1 second. No, I will put it a table form. Fine. I will put it in a table form. It will be more easy. Okay. It will be more easy. it will be more easy. 1 minute. Is it right? I will put it in a table form. How much is there? Interest is how much? Interest is how much? We are paying interest is how much? 10 million times 0.05. Is it right? Each year. For how many years we'll pay? We pay for 3 years. Is it right? We pay for 3 years. How much is there? Each year how much we'll get? We get 0.5. Okay? Principal. Is that it? Now it will be more easy. Principal at the end of year 3. Is it? And at the end of year 3, how much you will pay principal? 10. Okay. Now what is the present value? Fine. What is the present? This is column 1. This is column 2. This is column 3. This is column 4. Column 4 is 2 into 3. Is it right? What is we are talking about what? We are talking about the 3 years. Is it right? When you are talking about the 3 years, 3 years annuity value is how much? 3 years at the rate of, is this? Yeah, yes. The interest at the rate of 5% discounted at, allow me 1 minute. This interest at the rate of 5%. This is the nominal value. Is it right? This is the nominal value. Discounted at the required rate of return. Is right? Required rate of return. Required rate is how much? At the rate of 8%. Is right? What is the annuity value? Annuity value at the rate of 8% for 3 years. How much is there? 2.58. Is right? 2 means you are getting every year, you are paying interest every year 500,000. Is it right? You are paying how much? 500,000 into for 3 years. What is the annuity value? 2.58. It comes to how much? It comes to 12.9. Is right? It comes to how much? 12.9. Fine. Now what we have to do is see the thing. Is right? Now how much we are how much we are paying the principal amount. Principal amount is how much? Principal amount is it is 10 million. Is it right? Is that at the end of year 3? Is it right? At the rate of how much? 8%. What is the present value? Present value is at the rate of 8%. What is the present value? 0.79. Means 10 million 0.79. It comes to how much? 10 into 0.79. It comes to 7.9. One minute. 10 million into 0.5. 1 minute. 10 million into 0.05. 10 into 0.05. 10 into 0.05 into 2.58. Is it right? Is it right? This is 12.9, 1.29. Is it right? It is how much? 1.29. Is it 1.29 plus 7.9? How much you will get? 1.9 plus 7.9, 1.29 plus 7.9, it comes to how much? It comes to 9.9. 9.9 millions. Otherwise, 12.9 means you are having principal is 10 million. How you will get interest? How you will get interest of? How you will get interest of 12.9? Okay, it is how much? This is 7.9. Fine. If you take this is called as a debt element. How much is the debt? How much is the loan? Loan is nothing but the principal amount plus the interest amount at the rate of present value. Fine. At the rate of present value. Now, what they are asking, what is the year interest rate? Is it right? Interest finance cost. Is it right? What they are asking, they are saying that what is the finance cost? Finance cost, is it right? Finance cost is nothing but debt element year 1. Is it right? Debt year 1. Debt element into the required rate of return. Is it right? Debt element into required. How much is the debt element? 9.9. How much is there? 1.29 plus 7.9. You are not checking my calculations also. You are not checking my calculations also. It is 9.19. into 0.08, it comes to how much? It comes to how much? 0.735 million or 735,000. This is the finance cost for year 1. Slowly go into it. Is it right? See, we have first what we have done. Is it right? First what we have done. See, very simple. This is the step 1. And this is the step 2. Never we see what we have done. First we have taken the interest at the nominal. There are two rate of interest is there. Coupon amount is there, required return is there. Coupon amount is the amount which will pay interest, okay, at the rate of 5%. Fine. But it will be discount at the required rate of return, 8%. Is it right? They gave you the present values, they gave the. Why we have taken 2.58? Because it is equal for 3 years. Is it right? It is equal for, if it is equal for 3 years, we will take the annuity value. How much you got the present value? Is it right? We in here what we have got? We got the present values as such, PV. Is it right? We got present values. Present values, how much you got it? If for the interest 1.29 and for the principal 7.9. If you add interest plus principal, what will happen? We will have the, what is the debt element. On this we will pay interest. Okay. On this we will pay interest. How much we are paying interest? At the rate of 8%. We are receiving at the rate of 5%, but we are paying at the rate of how much? 8%. How much is the finance cost? It has to be recognized. It has to be recognized as 735. Okay? Are you clear about this? Just revise it. Okay? Anything is there, my help will be there. You have to ask me, then only I can understand that it is clear for you. Okay? What is the amount to be shown under liabilities? Is it right? What is the amount to be shown under liabilities? Fine. Now, what happens? See the thing. As on 30th September 2001, when they have taken 30th September 2001, is it right? Means they have completed 1 year. Is it right? They have completed 1 year. Is it? Completed how much? They have completed 1 year. Is it right? Now, what is the total debt element? Total debt element is how much? Is that we have calculated? Is it right? Total debt element is how much? Total debt element we have covered in step 2. Okay? How much is there? 9.190 million. Is that? What are the liabilities? Liabilities means both non-current and current liabilities. They are not mentioned anything specific. Liabilities means both non-current liability and current liability. How much is the total debt element? Total. This is the element when it is there. See, this is the element on when. This is the debt element on 1st of October. Okay. 1st of October 2000. Is it right? 1. Is it? This is the debt element. When it is there, this is the debt element of 1st of October 2000. Opening balance. Is it right? Total debt element opening is how much? Total debt element opening balance is how much? 9.19. Okay. Add. How much you are going to pay finance charges? Is it right? How much you are paying finance charges? Finance charges, how much you are paying finance charges? Year 1. Is it right? Finance charges year 1. Again, we have to take it from step 1. How much you are paying? 0.735 million. Is it right? How much you are paying? 0.7. Now, less. How much you have paid interest? Interest is right? 10 million times 0.05. Is it 10 million 0.0? How much you have paid? 50. This is minus. How much you will get? 9.19 plus 0.735 minus 0.5. It comes to how much? 9.425. How much is there? 9.4. What is first we have to calculate the total debt amount plus finance charges. It is a liability, is it right? They are talking about it is a liability. How much is this? 0.735. Next, required rate of return, is that? Then how much you are going to pay interest coupon rate, is that? See, this is what we have to identify. Here We are taken into consideration what? Here we are taking the required rate of return. And here we are taking into consideration what? Here we are taking the coupon rate. Whenever the bond is paid, the interest on the bond is paid based on what? Based on the coupon value. Answer is how much? 9.42. Is it clear about this? Do it separately. Do it on the paper. Okay? Do it on the paper so that it will be easy for us to understand. Is it? See, you 1 minute. This is completely different. Okay? This is completely different. Fine? We'll complete this and we'll stop. Okay? Calculations takes time. Okay? Calculation is, see, examination also, they will never give you a direct question. Is it right? They will give that. They will just twist the things as such. Is that theory questions are very easy. Theory questions, just you go revise it. You can do it very simple. Okay. If Britain has incurred a transaction cost in issuing these loan notes, how should this has been accounted for? Is it? If the Bread Rand Company have incurred transaction cost in issuing these loans, what is the transaction cost? Transaction cost is nothing but underwriter fee. Is it? Transaction cost is underwriter's fee. Transaction cost is nothing but brokerage fees. Is it right? Those are the transactions. Now what happens? See the thing. Is it? You have issued. Is it right? You have issued loan. Is it right? Loan notes. Is it? Assume you have issued loan notes worth 10 million. Definitely it is a cost. Is it right? You have to deduct it from the whatever the cash inflow will have. Is it right? What is the cash inflow? You have to deduct the transaction cost. Is it right? You have to deduct it from the whatever the transaction cost. Assume it is 5 million. Okay, 5.5. Okay, then the total proceeds is how much? 9.5. You cannot add it. Is it right? We were talking about the how transaction cost in issuing should have been accounted for. Is it right? You have to deduct it from where? You have to deduct it from the proceeds, cash inflow. Amortize. We are not going to amortize it. Is it right? We are not going to. It's not a finite life. If there is a finite life, it is amortization. But there's nothing that the value of the bond is related to this. Is it right? We will not charge as a finance cost. Finance cost is nothing but only the interest cost or the interest cost. That's all. Is it right? Finance cost is nothing but the interest cost. We are not going to, this is not a finance cost. This is going to be identified as a transaction cost. Brett Rand also purchased a debt instrument which will mature in how many years? 5 years time. See, is there 5? See, theoretical questions are very easy. Theoretical question doesn't need that, because of if our understanding of English is fine, theory questions we can take that, we can do it very easily. Brett Rand also purchased a debt instrument which will mature in 5 years time. Brett Rand intends to hold the debt instruments to maturity to collect what? Interest. Means they are going to retain it. Is it right? They are going to retain it. Retain it for how much? Retain it for full duration. Is it? They are going to retain it for full duration. Complete the following statement using the option. This debt instrument will be measured as a, whether it is asset or it is a liability. Whether it is an asset or liability. This is for the first one, this is for the second one. Bertrand also purchased a debt instrument will be mature in 5 years' time. They want to hold the instrument to maturity to collect the interest payments. They are holding it till maturity, till 5 years, till 5 years. For them it is a asset. You have purchased a bond. Got my point? Investment. You have purchased a bond. Investment. You purchased a bond for 5 years. For 5 years it will be an investment. It will be an asset to you. After 5 years, what will happen? Investment will be minus, cash will be added. One asset will, is it right? Till 5 years, is it right? Till 5 years, it will be identified as a investment. After 5 years, is it right? After 5 years, what will happen? Investment will decrease and the cash will increase. And now what happens? See the things. Got my point? Got the things? Keep it in mind. This is what? Is it right? This is the bond value. This is the value. Okay? This is the value and this is the time. Fine? This is the value and this is the time. You have 1, 2, 3, 4 and 5. Is it right? 1, 2, 3 and 4. What happens? In the beginning, the value will be at 1. Is it right? As the bond is reaching its time, the value of the bond will decrease. Is it right? This is one of the characteristics of bond. What happens? There is a inverse relationship. There is a inverse relationship between the bond value and time. Is that between bond value and time? This is that between bond value and time. That is the inverse relationship. Is that as in the beginning value of the bond will be more. Is it right? What happens as the time passes? Is it right? Here what you will have, I will put the thing. Here how many coupons you will have? 5. Here how many coupons you will have? 3. Here 4, here 3, here 2, here 1. By the time 5 years has been happened, the coupons will be how much? 0. Is it right? If this process is done, this process is otherwise called as amortization. What is the amortization concept? You should have a finite life. Impairment, infinite life. Whereas amortization, finite life. If there is any finite life, restricted life, value of the asset is decreasing, then it is going to be identified as amortization. Is it okay? We have done this. Is it right? Immediately I am sending you this file. Is it right? Immediately I am sending you this file. Okay, it will be the PDF. It will be there on the desktop. Is it right? I have. If you are seeing my screen, you can see the things very clearly. Fine. I have made a folder, everything clearly. Is it right? Now I will send you this file. Okay. Just revise these things. Next Thursday, again we are going to do something else on this. Tomorrow, is that tomorrow morning? What we are doing? 1 minute. Tomorrow morning we will do earning per share. Okay. Tomorrow morning we'll do earning per share. Day after tomorrow we are going to do events and provisions and events after the publishing date. Small, very small chapters. Is it a very small chapters? One means almost we can complete 1, 2, 3 chapters. We will not go fast. Okay, that is not going. We'll complete that. Hopefully, inshallah. Then on next Thursday, we'll do this. From Friday onwards, we'll start group accounts and cash flow. It will take time, but it is also very important. The moment you are doing group accounts and cash flow, almost we are revising from the beginning.